Alright, so I've been receiving a lot of questions, both online and offline, asking me how do I carry out step 6 of my value analysis, which is the calculation of the intrinsic value of a company, and asking me how do I derive at this value of Apple, for example, or FedEx or UPS, and so on and so forth. So therefore, I thought it would be more beneficial for everyone if I do a basic explanation of how I derive and calculate the intrinsic value of companies. And with this understanding, I feel that it will be much better for you when you watch my future videos, especially my upcoming videos where I will be evaluating the FANG stocks, the top 5 most well-known stocks in the US market. So basically, I apply what I call a modified discounted cash flow method to derive the intrinsic value of the company. Now, a quick search over on Google about discounted cash flow will give you such an equation. So if you look at this scary looking equation, we have the discounted cash flow is equal to a sum of cash flows divided by 1 plus discount rate, and that's compounded by the number of years, so n. So don't worry so much about this equation for now. What you need to know is this picture. So imagine you have a money making machine over here that will be generating money for you every year consistently. So let's value each of the coin here at $1, and it will produce $1 for you every year for 5 years. Now in such a case, the critical question will then be this: what will you value this machine? Now, will you value this machine at $5? Or will you value this machine at less than $5? Now, if you value this machine at $5, let me know by clicking on the like button. And if you value this machine to be less than $5, also do let me know by clicking on the subscribe button. So, take a moment to think about this question and have an answer in mind. Alright, have you decided on an answer? So, for those of you who have chosen to value this machine at less than $5, give yourself a clap and a pat on the back. While for those of you who have chosen to value the machine at $5, don't fret, you just need to understand the concept of the present value. So the concept of present value just means that whatever amount of money in the future will be much lesser now. Now this may sound counterintuitive, but take a moment to think about it. Now you may ask me why. Now the basic answer to this question lies on 2 important reasons, and that is interest rate and inflation. Now think about it in terms of interest rate. Whatever amount that you don't get to receive now is an opportunity lost to put it to good use, either to invest it or even by saving it up at a bank, you receive the interest rate. So for example, if you were to invest $1 right now at an interest rate of, let's say, 2%, a year later, your $1 will now be worth $1.02. So now can you see why future money is worth lesser right now? And the second reason is due to inflation. So with inflation, your buying power decreases. The $1 that you have now may be able to buy you, let's say, a movie ticket. But 5 years down the road, the same dollar that you have might only afford you maybe, let's say, half a movie ticket. So therefore, future money is always worth less when you value it at the present moment. So I hope this is now clear to you. If it's still confusing to you, you can watch this video again and let it sink in. So I repeat, present value simply means that whatever amount of money that you will receive in the future will be worth much less now. Therefore, if we come back to our money-making machine scenario, I hope now you understand why this machine that is giving us consistently $1 every year is only worth less than $5. Why this money-making machine that's giving us consistently $1 every year is worth less than $5. This is because at the present moment, the only value that this machine provides us is $1. And the subsequent value that the machine provides to us is at a future date. And therefore, if you convert it to the present value, it will be worth much less. So these 4 future coins will be worth much lesser than $4. And therefore, this entire money-making machine is worth less than $5. So with the analogy put forth just now, I hope you can better understand this scary looking equation. I hope it doesn't appear as scary to you anymore. And basically what this equation tells us is that each coin that we are seeing over here is the cash flow. And because future cash flow will be worth much lesser to us now, we need to apply a discount rate to the cash flow. So how this discount rate is determined or set, I will be explaining further on in the video. Now, if you understand this equation, you have realized something that is fundamentally flawed, and that is, when investing in a company, in our analogy here, this money-making machine, we expect our money-making machine to be growing and not stay stationary. So what this means to us is that while the company grows, cash flow that it generates and provides should also grow together. But if you look back at this equation, the cash flow that we are summing up over here has always been consistent throughout the number of years. So therefore, the simple discounted cash flow you can simply Google up online can never satisfy our needs in deriving the intrinsic value of our money-making machine, in our case, the company that we are investing in. To further explain my analogy, the discounted cash flow over here is simply the value of the company that we are evaluating. And the cash flow in this equation will be replaced by the operation cash flow of the company. And in order to derive the intrinsic value of our company more accurately, we will have to do some simple tweaks to this equation. So the operation cash flow that a company is generating must be increasing as the company grows. So how much should we increase this amount, you may ask? Well, we simply just multiply ops cash flow by the growth rate of the company. And when represented by the math equation form, it will simply be OCF multiplied by 1 plus the growth rate. So where can we get these important figures? So I have not shown this previously, but for the operating cash flow, I prefer to come over to Morningstar to get the trailing 12-month figures. So under Morningstar, over at cash flow, we look at the cash flow from operating activities, indirect. Now remember to sum up all the subsections that are available under cash flow from operating activities. So from here, we get that the cash flow of Apple, in today's example, have a trailing 12-month operating cash flow of 69 billion. So take note that the unit is in billion. And what about the growth rate of Apple? So if you recall from our value analysis, growth rate of a company can be obtained from FinVis. So under FinVis, we look at earning per share next 5 years. And for Apple, it is estimated to be at 10.19%. So in the case of Apple, this equation will be looking like this. Take note of the units, 69 billion multiplied by 10.19%. So that is 1019. And just like the discount rate, we will have to compound it over the years. So every year we need to multiply it by 1 plus 10.9% and all the way until 10 years. That's generally the time span that we are using when calculating the intrinsic value of a company. Now you may question, previously in FinVis, we are looking at the earning per share of Apple for the next 5 years. So earning per share next 5 years is 10.19%. Now what happened from the 6th to the 10th year? Well, generally the rule of thumb that I use is if the estimated growth rate of a company is reasonable, that is maybe let's say less than 15%, I'll just apply that value to be the value for the 6th to 10th year growth rate as well. However, if the earning per share of the company is more than 15%, I'll just assume that the growth rate for the company for the 6th to 10th year will be at 15%. The reason is because we want to be a bit more conservative over here. The higher we project the operation cash flow of a company, the higher the intrinsic value of a company that we will get. And come to think about it, if an analyst estimates the growth rate of a company to be at, let's say, 50% for the next 5 years, how likely is it to remain at 50% year over year for 10 years? How strong must the company be in order to achieve a 50% growth rate year over year for 10 years? To keep ourselves on the safer side, I tend to be more conservative and to bring the growth rate of the company from the 6th to 10th year down to only just 15% and evaluate from there. Now the next important question comes. What is our discount rate? So for the discount rate, I generally use a figure of about 5 to 9%. And how I determine my discount rate is based on the volatility of the stock. So just like before, if we head on over to Finviz, you can get the volatility of the stock beta to be at 1.22. Okay, so what does the beta tell us? The beta measures the volatility of a stock in comparison to that of the broader market. The broader market, you can take it as the SPY or the SPX, the index that tracks the top 500 US company. So a beta of less than 1 would mean that the stock itself is less volatile than the broad market. So in such cases, when you have the SPY swinging like that, the stock price of the company with a beta that is less than 1 will only be swinging like that. On the other hand, if you have a company with a beta of more than 1, while the SPY goes in small swings, the stock price of the company may experience large swings such as this. So therefore, what this translates to us is that the lower the beta, the less volatile the stock price of the company. A lower volatility generally means that it is on the safer side, and therefore we use a much lower discount rate. And on the other hand, if the stock of a company is always experiencing large swings up and down, that will give us less confidence in the stability of the company and the value of the company. And in such cases, I generally tend to apply a discount rate of 9%. And so with that, we have covered all the parameters that are required of this equation, and that will give us the intrinsic value of our company, of our money-making machine over here. Now, remember that this is the intrinsic value of the entire company. And when we buy a company, we buy them in shares. And that is, we buy the company in pieces. So therefore, we need to divide the intrinsic value of the company by the number of shares that it has outstanding. And this value is again gotten from Finviz. So in Finviz, we see that Apple have a shares outstanding of 4.57 billion. And therefore, we need to divide the intrinsic value, whatever amount that we get just now, by 4 billion shares. And that's not all. A company might have some debt or leftover cash that it is holding. So for example, like Berkshire Hathaway with a large cash hoard will worth more, while a company with a large amount of debt will generally worth less. So therefore, with the intrinsic value of the company per share, we next need to add on cash per share that a company has and subtract the debt per share that a company has. And that will give us, tada, our final answer, the intrinsic value of the company per share. So the next critical information comes. Where do we get the debt per share and cash per share of a company? Now generally for these two values, I prefer to refer to the last quarter in the financial statement of a company. And let's go over the sources where we can get such information. So since I'm over at Morningstar, I'll just continue using Morningstar for our case today. Now, so under balance sheet, remember to click to quarterly because we just want to look at most recent quarter. And under total assets, we want to focus at the cash and cash equivalent. So we sum this section up. Now, short-term investments can be liquidated as and when a company like usually. So they can be translated to cash on hand as well. So I generally tend to include this. And therefore, we see that Apple has a liquid cash of 94 billion. Now, remember also convert this back to cash per share by dividing by the number of shares outstanding. And with that, we move on to the debt that Apple has. We want to focus on the long-term debt and the short-term debt. So we can see that long-term debt is over here, 84.94 billion. While for short-term debt, we want to just focus on here, current debt and capital lease obligations. So that will give us 23.48. So if we sum up these two numbers, 23.48 plus 84.94, that will give us a debt of 108 billion for Apple. And remember as well to divide this by the total number of shares outstanding that Apple has to get the debt per share. And so with that, guys, we have come to the end of our intrinsic value calculation. I hope you have understand everything out of it. And next, we move on to look at exceptional cases. Remember, there are always exceptions in life. So the same applies when we are calculating the intrinsic value of companies. Now, if you remember, in my Micron analysis video, we faced an exceptional case, and that is Micron having an so-called unrealistic exponential growth of its cash flow from operating activities. So from here, we see that the cash flow from operating activities of Micron has been decreasing generally, or rather staying flat. And then suddenly from 2016 and 2017 onwards, it experienced a huge spike upwards. So in such cases like this, if we were to just use the trailing 12 months of 16.1 billion, well, it may sometimes give us unrealistic numbers as the intrinsic values of the company. If you head on to watch my Micron videos, I'll review over there, even at a growth rate of 0%, we have an almost absurd number to be for the growth rate of Micron. And therefore, in cases like this, an alternative will be to consider the net income trailing 12 months of the company. Now remember that net income also must be increasing consistently in order for us to use it reliably. Although generally I prefer not to use the net income because the operational cash flow is a more direct inflow of cash to the company. So if you remember earlier on, we were met with the second exceptional cases. And that is sudden dips and spikes observed in UPS. Now from the cash flow of operating activities in UPS, we see that UPS is generally doing rather well, almost flat, and suddenly in 2017 it experienced a dip, and in 2018 suddenly it experienced a huge spike. So for cases like this, there are a few ways that you can go about solving it. The first one is to use the trailing 12 months operating cash flow of the company, provided that this figure over here is not so far off from the figures that is before the sudden dips and the spikes. Or if you don't prefer to use this method, you could also take the average of the anomaly years. And in my video, I chose to take the average from the 2018 and 2017 figures, and that gives me the average of 7 billion. So these are the general difficulties that you will be encountering when you are calculating the intrinsic value by yourself. And if you have any questions, feel free to drop a comment below, and I'll make sure to reply to it as soon as possible. So next, let's apply what we have learned so far. So let's apply what we have learned today. Do you still remember what are the critical parameters that we will require to calculate the intrinsic value of Apple? Now pause the video here and take a moment to find them and derive the value for Apple yourself. After you have derived the answer, come back and check your answer. So in summary, this is what we have seen today. The parameters that is required to calculate the IV of Apple. Ops cash flow of 69 billion, total debt of 108 billion, cash 94.6 billion, 10-year growth rate of 10.19%, shares outstanding 4.75 billion, and a discount rate of 7.5%. Now, what is your answer? Using these parameters, the answer that I've derived at is, drumroll, $168. So now that we have gotten the intrinsic value of Apple, what can we do with this figure? If you have not watched my video on how to purchase wonderful company at a great discount, head on over there and I'll do an in-depth explanation of how to analyze companies and how to make good use of our intrinsic value. If you have benefited in today's content, do click on the subscribe button and turn on the bell notification to receive future updates, and also share this with anyone whom you believe will benefit from my video. With that, I thank you and see you in my next video.